Welcome, everybody. I would like to thank you for joining us today for today's Wednesday Wisdom entitled Power Your Firm by Understanding Your Numbers from Financial Statements and Budgets to Goal Setting. I'm Judge Jennifer Kuyrkendall Griffin. I'm moderating this free CLE today for the Solo and Small Firm section, of which I serve on the Executive Council section. We are an elite section of the Florida Bar that offers a number of great opportunities and resources, especially to those who are solo practitioners or in smaller firms. Please check out the section to get more involved. As to housekeeping matters for today's CLE, the audio feature is turned off for participants, so if you wish to ask questions of the speaker or need technical assistance, please utilize the question and answer feature. All questions will be answered kind of in line within the program. Whenever there's a good break for me to interject the question to our speaker, I will ask it on your behalf. And then we'll have any closing questions at the end. I would like to recognize our sponsors whose logos you can see here on the screen for their contributions to this section this year. We have Florida's Lawyers Mutual Insurance Company, InfoTrack, Clio, Align CPA, CIO.Legal, Alonzo Appeals, Feld Legal, Gilbert Garcia Group, Attorneys at Law, Massey Law Group, and RT and AP Mediation and Law Group. I encourage you to explore the member benefits offered by each of the section's sponsors. Our speaker today is Joy Lutz. Joy is a CPA, a certified tax coach, and owner of Align CPA, which if you did not notice, she is also a section sponsor. So definitely get with her to see what kind of member benefits she offers to our membership. She's located in Lake City, Florida, where she helps solo and small law firms with accounting, tax prep and planning, and advisory services. Joy is a certified tax coach with the American Institute of Certified Tax Planners and was named a top 40 under 40 CPA in the accounting profession for 2015 by the CPA Practice Advisor, as well as earning Small Business of the Year Award in 2016 by the Lake City Columbia County Chamber of Commerce. She is involved in many organizations and has held leadership positions with the Lake City Chamber of Commerce, Ronald McDonald House, Happy House, and Altrusa. At this time, I'm going to turn things over to Joy, and I'll turn my camera off, but I will be here to insert your questions as well.
Hello, let me see. Okay, there we go. Just a couple technical difficulties, but I won't give you my whole bio again because Jennifer did such a good job at that. But I will give you a little background of like how I got here as far as working with law firm owners. I had a law firm client that came to me and I was able to help her kind of reorganize her business, understand her accounting, get everything kind of in line, do some tax planning. And she said to me, you know, you should really think about doing this for other law firms. You'd be great at this. And so that's where our niche started. So that was probably 5 to 6 years ago. So since then, we've added lots of attorney and law firm clients that we really enjoy working with. Let's hop into it and go from there. So you may notice me looking down, reading something. As much technology there is in the world, PowerPoint always seems to get the best of me. And so I did print my notes since I cannot see them on the screen. So that'll be a lot of fun. I do want to encourage you guys, though, to ask questions and type them in because I'd be happy to answer them. I want to make sure you guys get the most value out of this, and whatever that is, I'll be happy to answer on. And if there's financial or even tax questions you want to ask and they don't fit within the content, feel free to post those and we'll go over those at the end. All right, so I love starting with this quote, what got you here won't get you there, because I'm sure you guys are in firms and growing firms and have established firms. But if you're looking to get to the next level, you're going to have to change some of your habits and you're going to have to start changing some of the things that you do, because all of the steps and habits that you have now got you right to where you're at. But if you want to up level, we're going to have to change some things. So my goal today is to kind of help you understand some of the financial things that you could do in order to power your firm and get to that next level. I think it's super important that you do understand your numbers because they tell a story, and we want to make sure that they're telling the story that we're after. And so in order to do that, we've got to understand what we're looking at and what these financials mean, and then we can start to understand how to make them better. Today, we're going to go through 9 financial key concepts or areas that will really help you get your firm to that next level, or just help you in your knowledge in general to manage what you're doing now. Before we get started though, I want to touch on a couple of things. The first thing is mindset. And I think this is super important, that you have an open mindset about finances and about getting better if that's where you're at. Because I think that what I've seen in my career is a lot of people carry shame around their financials or their finances or their firm and where it's at. And I really want to encourage you to let that go, because shame is not going to serve you in any way. It's not going to help it get better. The only thing that's going to help get better is to educate you and then to start taking those action steps. So let's kind of keep that in mind. We're going to let that go. And then also, but before we jump to the next one, it's important to know that you can't ignore this. Like, financials are not going to get better by ignoring them. And so it's something that we want to look at head on. Even if you're not where you want to be, we want to know where that space is so we can get better. And the second thing we're going to mention too is goals. That I really want to encourage you to have financial goals for your firm. That's going to help you know if you are where you want to be. And so setting like a 3-year and a 1-year target is really important, because then we know what we're working towards. We know what that middle ground is and what we need to improve. And it's just going to help if you have a team, it's going to help your team help you get there also. And then the third thing is stop comparing yourself to other law firms. I know that's probably really hard to do, because we have people who are mentors or firms that you look up to and you want to be like them, or you see people posting on LinkedIn or Facebook about all these amazing things in their firms, and you think, oh, I'm not there, or I should be there, which is, should is a horrible word to use because it implies a lot of shame. And so you don't want to compare yourself to other firms, because you're going to have goals that are specific to your firm and to your family and to where you want to be. So comparing yourself to the guy next door is not going to get you there. And in fact, it's probably going to, decrease or hurt your mindset because of those things. And anytime you want to grow or you want to improve, we're going to not compare ourselves to others. All right, so we're going to hop into it. We want to understand our balance sheet and why it is more important than a profit and loss. And then we're going to look at how do we know if it's wrong. So this is probably the first thing that I start with new clients, because there's 2 main financial statements that you should look at every month, and that's the balance sheet and the profit and loss. And what we find is most people don't look at the balance sheet. They only look at the profit and loss. And the problem with that is if there are errors or inaccurate numbers on the balance sheet, your profit and loss is going to be incorrect too. And so now you're just looking at wrong numbers. I would even say on the higher end, about 90% of new clients that come to us, they either have never looked at a balance sheet or the balance sheet they're looking at is wrong. And again, in the next slide, we'll kind of talk about why that matters most and how we can start paying attention to it and recognizing if something's wrong. Because I don't expect you guys to become, a CFO or this expert accountant in these things, but you have to have enough knowledge to know when things are inaccurate so you can push back on them. So this is a typical balance sheet, especially for law firms, because you'll see on here, we've got bank accounts, trust accounts, receivables, all of the things that you own. So your assets are things that you own. And then we're going to hop into liabilities. Those are things that you owe. And then equity is leftover. So that's your money there. Sometimes it's not real cash money in equity, but that is what's left over and applies for your equity. So what we want to do is understand where these numbers are coming from so that you'll know if they're right or not. When you walk down a balance sheet, you'll notice that with bank accounts, these accounts should be reconciled every single month. And that's how we're going to know that they're right. The same thing with your trust account every single month, and we'll hop into detail on that in a minute. Accounts receivable, you should have an aging list that makes up that $23,000 so that we know that it's right. And what I really want to encourage you to do, like if you have a bookkeeper in your office or you have someone else who's doing this for you, I want to encourage you to sit down with them and have them explain the balance sheet to you. Because that's going to give you a lot of information there. It's going to let you know, do they understand this financial statement? Do they understand the numbers on it? Because any good bookkeeper should be able to go down any of these numbers and tell you where they come from and why that number is accurate. Basically, there's a work paper that backs up all of these numbers to explain why it's accurate. So if your bookkeeper can't do that, then you really should consider investing in some sort of training or course to get them up to par so that they're able to help you with this balance sheet and making sure it's accurate as well. I will say too that many times in law firms, what we'll see is they'll have the receptionist or the secretary or maybe even the paralegal do the bookkeeping. And I know that that seems like it might help you with your cost and keeping those low, but it's really a very expensive error to make if that person doesn't have experience with bookkeeping and accounting. Now, they may have knowledge and they may have done it for years, which is fantastic. So they'd be perfect for that position. But don't just assume that your admin staff understands accounting and can do this for you. It would be like me hiring my admin to start writing contracts for us. Like I would never do that. So you should also kind of consider that in your firm. But if it is something that you can't have an outside person or you really want this person, sometimes we'll see spouses doing it. Invest in their training. You know, you went to law school, I went to school for accounting years and years. Like we have this knowledge because we've invested in our education and our training, that we need to do that same thing for our staff, especially for our bookkeepers, because they're in charge of all of the money. And this is what's really going to give you the power to know that it's accurate and to make the best decisions, because now we're making decisions off of accurate financial data. So number 2 is regular reconciliations. What does that even mean and how should it be done? So a reconciliation is just simply where you get a bank statement in from the bank and you compare it to your accounting system and make sure that they agree with each other. And then it would show you a list of outstanding items. This should be done every single time a bank statement is released, which is typically monthly. Every now and then you'll see quarterly, but that's usually just with a savings account. And the reason that this is so important is that if the transactions going through your bank account are not correct, either the amount or you may have duplicates or things not posted into the accounting system that did clear the bank, if those aren't accurate, then your profit and loss and your balance sheet are inaccurate. So then we're making decisions off of bad numbers, and that's what we don't want to do. So we want to make sure we're keeping those records correct. And then obviously with the trust bank account, that must be followed. We'll talk about the trust account in just a minute. I won't get into too much detail with it, but we will at least cover that and what your accountant or bookkeeper in-house should be doing to make sure those are right.
Joy, if I could interject, there was a question whether you provide bookkeeping services to your clients, and maybe you could also answer it more broadly. Is that more of a bookkeeper role versus accountant role, or do they sometimes do both?
Yeah, that's a great question. So we do outsourced accounting. And so that means we do your bank reconciliations. We reconcile your balance sheet. We reconcile trust accounts. We do 3-way reconciliations for all of our attorney clients. And so we do the full service of accounting. The portion we don't do is we don't do bill pay or accounts receivable. I think that's really important to keep in your office. And then we also do payroll, tax planning, and tax preparation. The way that we do our services is a monthly package, and we do that for a couple different reasons. But one of the main reasons is our goal is to help our clients be more successful, whatever success is defined for them. And we can only do that if we know we're looking at accurate data. So we give them that data, and then each month we give them communication on here's what this means, here's how it could be better, or here's what we could do differently. And then on the tax piece of it, we do that because I hate surprises. I don't ever want to tell someone they owe 50 grand and they thought they owed 5,000. And so we know year round where you're going to be for taxes, and we're eliminating all of those surprises. Great question. I did not even plant that question to the group, so I appreciate that.
No, it was definitely asked, and I've got another. Why would a firm's IOLTA account be on the firm's asset list, as IOLTA accounts are client money, not attorneys?
Correct. We do put that on the books, and you'll also see the liability on the books as well. And there is some discussion on that. And as far as does that go on the financials and does that go on the tax return? And although that is the client's money, the firm's name is on that account. And so we put that on the books. So that's why you're seeing that there. And I'll add to that, we do have some clients that will not run their trust accounts through their main accounting system. They will do a second set of books just for the trust account. We typically see that when there are a lot of transactions. You know, we may have a firm that has 10 trust transactions a month, and then we have a firm that has 200 a month. And so those things are going to come into play on whether we're going to run those in the same books or if we're going to do a separate books. The only reason we would do a separate set of books is because of the volume. And a lot of times that firm will have a practice management software that has a lot of glitches in it and either breaks and doesn't import, and it just creates a bigger mess. And so it's easier for us to correct that and fix it if it's in a separate set of books. Okay, cash is king. I'm sure you have heard that before, and here is why. If you want to grow a firm, growth is very expensive. You're going to have to hire employees. You may even need a new office. You're going to need new hardware, software. You're going to spend on advertising and marketing. And so those costs really start to add up, because typically you have those costs before you have the revenue to support it. Your bank also is going to want positive cash flow. They want to see that you can make your current payments, and then can you make payments on a new loan? One of I think our best of marketing pieces is something we push out on social media, and it says lender ready financials. Because if you have ever tried to go get a loan and you don't have financials in order, it can be a nightmare. And our goal is always to give our clients, you know, basically at any time, or at least, you know, 15 days notice, clean financials for the previous 1 to 2 years, so that we're not holding them up and they can go get a loan if they need that. But it's very important to understand your bank is going to want to see positive cash flow. So we're not going to want to drain everything out of the firm. And then buyers, if you're thinking of selling your firm, whether that's, you know, now 3 years, I would say 5 years out, then this is when you need to start thinking about that, because you want to build this firm up so that when you are ready to sell, you can sell for the most amount of money. And a buyer is looking for a well-oiled machine. They want to see that the firm is profitable and generating cash on an ongoing basis. They're going to want that return on investment. And so we're going to want to have strong, clean financials in place for when you're ready to do that. One thing I will say too on this is, if you are wanting to grow, this is where like your financials can really become a great tool for you. We had a client that was wanting to aggressively grow, and so we were able to kind of sit down with him and figure out how much time it takes to onboard an employee and train them, and then actually getting them to where they're producing revenue. Because unfortunately, that's usually not day one. But when you can start to see, oh, well, that's 90 days out, you can start to plan for capacity and you can plan for new clients, because now you know what that time period is. But you also know how long you're going to have to pay that employee before they're generating any revenue. And so having all of that knowledge is going to help you know when you can take the next step without jeopardizing the rest of the firm. We're trying to make decisions off accurate information that are also going to give you confidence that they're going to pan out, because it's off of real data. And the worst position you can be in is you need to go get a loan, especially a line of credit. I always say, go get a line of credit when the books are really good. You've had a really good year of income, even though you don't need it, because the bank is more likely to give it to you then than it is when you really do need those funds and you're trying to grow. So if you're in a good financial position, I would consider getting a line of credit if you think that you want to grow over the next year, 2 years, and go ahead and lock that in place. Because a lot of banks will give you a line of credit, but not require you to actually start using it. Or you could use it and pay it off the next month so that you're not generating extra interest expense, but you have that in place for when you're ready to grow. And the only other thing I'm going to say about cash is king, because probably the biggest issue we see is excess distributions. And so when you're just pulling money out of the account left and right and out of the firm left and right, then that's going to be really hard to do all of these things. And so figuring out a way to keep that separate, as far as personal money needs to go into personal accounts and nothing to do with the firm, and then the firm money needs to stay in the firm. Obviously, you need money to live and need to take draws or distributions, which is great. But if you're wanting to do any of these three things, then you're going to have to leave more money in the firm so you can build up that equity section on the balance sheet, because that's what your lender is going to look at. Well, I guess I really like this screen, but it's not letting me go to the next screen. Okay, so cash is king. We want to manage our firm with multiple bank accounts. I don't know if any of you are familiar with the profit first method. I do like that method. I will say it can be a little overkill and overwhelming. And so there's a way that you can do that on a lower scale. But we want to make sure we have multiple bank accounts. We're going to need an operating account, a savings account, a tax account, and obviously our trust account. And the reason you want to do this is so that you can put money into buckets for when you do need them, and they're earmarked for that. For instance, if obviously if you're profitable, you're going to owe taxes. There's no way around that part. And so it is best for you to go ahead and put that money aside throughout the year as you're paying estimated tax payments to the IRS. That way, you're not having to come up with this big lump sum of cash come tax time. The best thing that you can do is look at your previous tax return. And if you divide your taxable income, your tax by your taxable income, that's going to give you an effective tax rate. And that would be the rate that I would put into the tax account every single month. So let's say your effective tax rate is 15%. Every month, after a monthly close, you're going to look at your profit and loss, that bottom line number, and you're going to take 15% of that, and you're going to move that cash into the tax account. That way, you know what is in that operating account really is yours. And that's what's going to help you to grow. The same thing for the savings account. You know, if you want to buy a building, that's probably one of the most common things that we hear is, you know, I'm going to need a down payment on real estate. Well, we want to go ahead and start saving for that now and figure out, are we going to be able to afford that when that time comes? What I would do in that situation is figure out, what is this piece of real estate going to cost us on a monthly basis, and start moving that into your savings account. And you can see, you know, do we have the cash to do this, and how long can we do this? Now, obviously, there's a lot of factors that come into that, that concept seems really simple, but can get complicated. But I would say keep this as simple as possible. And even if you're like, hey, I don't know what my tax was, but I'm going to move $1,000, just go ahead and start the habit of doing this and moving money into a savings account, because that's really what we're trying to do, is to build our habits around financials. And when you start doing that, surprisingly, after a couple of months, you don't start to miss the money. You know, I know when I first say this, you're probably like, we're on pins and needles here. We don't have all this extra cash to move. But if you start, and even start small, and you start building that habit, and you do it a couple months, you'll notice that you don't really miss the money. So I really want to encourage you to do that. And then one of the questions we always get is, how much cash do I need? So that is always a personal preference, because that is going to be dependent on, you know, do you want to grow? Are you trying to hire employees? Or, you know, do you have a young family? Do you need to take as much cash out so that you have it for your personal bills? That the dollar amount you keep in your operating account is very much a personal decision. We work with some attorneys that are super aggressive, and they have no problem bringing that bank account down, you know, pretty close to zero, or, you know, somewhere in that range. And then we have some that are super conservative, and they want to have a lot of money in their bank account. And what we found is that's just a personal preference, and the person running the firm on how they handle stress, I guess, is probably a good one, because some people, you know, they have no stress when there's no money in their bank account, and then some people are high stress. So we want to keep stress down too. So let's look at our profit and loss and figure out how much cash do we need. This is going to be a really simple example, but what I would do is run a 12-month profit and loss. And we're assuming this profit and loss is accurate. So only do this after you've went over your balance sheet and you know it's correct, and you know your profit and loss is correct, because your bank reconciliations are done. But you're going to take your total expense down here, and we're just going to divide it by 12. So that gives us $14,000. What that tells me is it's going to take $14,000 to run the firm every single month, even if we bring in zero revenue. And so you want to start to put some of that aside in case you have a month where revenue is down. This number also is what is known as your break-even number, which is important to know, and it will change. But this also, as assuming this is how much cash you need for the month, that this is a very basic example. That's assuming you're not taking out distributions. It's assuming you're not making principal payments on loans and things like that. So this is a very basic number. Yours is going to be a little different, but this will give you a starting place of where to start. And then with that break-even point, that's super important to know, because like I said, you know what you have to bring in to break even and then to be profitable. And you can start to see how can we make that number less, because that's where you'll start to cut costs. You know, if you can bring $14,000 a month down to $12,000, that's a, you know, pretty good cost savings that you've found there. This is just not going to be my friend today. Okay, so let's jump into trust accounts. Again, we'll keep this kind of high level. I'm going to assume that you guys are all experts, and I know that you're all doing this correctly, but I can't talk about finances for law firms and not touch on the trust account. So I will say first, I know that you guys know you are number one ultimately responsible for this trust account. It does not matter if you have in-house bookkeeping, outside outsourced accounting, or anything. It's you, your name's on the door, you're responsible. So this is something you should absolutely look at each month. I would look at this each month before I looked at anything else, because if this is not correct and you have issues and things go really wrong, you may not be able to generate income anymore. So we do not want that. What you want to do is you want to look at your balance sheet and see, okay, my bank balance and my client trust liability account, those must be the same amount every single month, every single day. And so if you look at your balance sheet and those two numbers don't match each other, you do have a problem there. And then you need to make sure that it's reconciled each month. Now, you're required to do a three-way reconciliation, and so that's where we're going to look at the bank. We're going to look at our client records or our client ledgers, and then we're going to look at, usually most firms these days we see are using like a practice management system or a trust management system like Clio or Practice Panther. We've used several of them. I do think Clio is probably the most popular. I'm not saying it's the best, it's probably just the most popular. But the biggest mistake that we see is you will run your trust account through Clio and then not compare it back to your books. And what the error we usually find is that whoever's making the money moves in Clio will sometimes forget and to make the move in the actual bank account. So let's say, Mr. Hutto here down here pays you $500. Well, I'm going to say that backwards. Let's say that we refund him $500 and we record that in our Clio system. Well, if it's not importing in or it doesn't import in correctly and your bookkeeper forgets to go and actually refund him $500 in the bank account, then these numbers will not match back to your Clio reports. And so you're not going to have a three-way reconciliation. So I just want to point out that you have to compare all three to each other every single month to make sure that they're on target and that we're actually moving funds when we're supposed to.
Joy, if I could just interject while you're talking about trust accounts, fairly recently, the Florida Bar did come out with a free trust account software. If you go to trustnota.com / the Florida Bar, TRUSTNOTA.com. It is something that is completely free. Also, not only do we have section sponsors that offer discounts to their trust software, as a Florida Bar member, if you'll look at member benefits on the Florida Bar website, you'll find other places for trust software also. And then a question, could Joy cover client ledgers in more detail? I don't know if that's happening or not.
Yeah, I don't have that prepared today, but if you want to shoot me an email, which my email will be on the end, and give me a little more info on what you want, I will shoot you over a video of either how we do things or answer your question in that manner so that you have that. Okay, let's hop into know your labor costs. So this is for you guys, and even for yourself. I was going to say this is for you guys who have employees, because I know some of you don't, being a solo firm, but it's also applicable to you yourself. You want to know what it is costing you in labor. This is going to help you determine if you can hire someone or when you can hire someone. And then also you could start to track your revenue by employee, so you can see I don't want to say which employee is the most productive or profitable, but you can see areas of improvement, or you can see areas of when employees are starting to get at capacity and things like that. So these are great numbers to know. What this tells me here is we're spending 58.9% on labor. So of our revenues, 58.9%. So for every $1,000 we bring into the firm, we're going to spend $589 in labor. And that's really not off base. Your labor can be, I mean, we've seen it, we don't see in the 30s very often, maybe 35% up to 60%. And this is where it comes into play about not comparing yourself to others. Because if you're trying to grow a firm, your labor percentage is probably going to be much higher than a mature firm who's been in business for 50 years. And the reason is you're having to hire new staff as you're getting new clients. And so all of your staff probably aren't up to capacity or close to it. And so your labor metric is going to be much higher than a mature firm. So again, we're not going to compare ourselves to others. And I will say too, on benchmarking, we do some benchmarking. What that means is where you're comparing your firm to the industry. We will do some, but I will not let clients get hung up on it. And that's the whole reason. You don't know who you're benchmarking or comparing against. And their goals and their firms are so different than what yours are that we want to know the number and then we want to move on. So we're not going to get, sucked into that. Okay, budgeting. This is everyone's least favorite, mine included. Especially, well, I was going to say all the females on the call, but I don't like to stereotype us because there's lots of men that spend plenty of money too. Like no one wants a budget, but if you want to achieve your goals, you're going to want to have a budget. So this is something we want to do annually. We also want to start at the bottom and decide how much we want to make and then work backwards. We typically see firms doing that in the opposite, where they'll decide how much revenue is coming in, how much labor, and then they get to keep what's left over. But that's not what we want to do. We want to decide how much money do we want to make, and then we're going to work backwards and we're going to reverse engineer. And if any of you love this concept or want to know more about budgeting, there is a book. It's called Simple Numbers by Greg Crabtree, and it's a fantastic book. And that's where this concept really comes from. So if you're a reader and you want to know more about it, that's a really good read.
Joy, before you go on to another slide, back on screen number 5, the question is the 58.9% based on gross income of the firm?
That 58.9% is based on total revenue, so a top line. So that would mean if you had revenue of 100,000, you would have labor cost of 58,900.
All right, thank you. And then kind of along the same lines, do you have a recommended percentage of labor cost to income? Same question for marketing as to percentage of income.
I think both of those numbers are very dependent on whether you are a mature firm and not wanting to grow, or if you are in growth mode. If you're a mature firm, we like to see labor cost, I want to say in the 40th percentile, probably. This is also going to be dependent on if you are in production, you're an attorney in the firm, or are you overseeing kind of how you pay your salary? So there's a lot that goes into that labor cost, but I like a 40% range. And then I have the same exact answer for the advertising and marketing cost and what that should be, because it depends on if you want to grow. I think if you want to grow, you need to be around 10% in advertising and marketing. But that's going to be different. That percentage may be different for, a $2 million firm versus a $250,000 firm. So because at some point that number starts to taper off, and at some point that number is too big, because let's say you're a solo practitioner and you go out and you start spending 15-20% on advertising, you may have just created a huge problem for yourself, because now you have a ton of work to do and not enough time to do it. So I look at these things as like levers that we're pulling in our firm. So you have to figure out what lever you want to pull right now and how hard you want to pull it. And those are all very dependent on your goals and where you're taking the firm. I'll say like personally for my firm, we just bumped up our advertising and marketing budget to 15% because we are aggressively growing. Whereas in years past, we've kept it somewhere around 5 to 8%. So, it's just very, very dependent. And then also in your advertising and marketing, how you're spending that money. We see a lot of law firms that are getting clients from referrals. So that is like the least expensive amount of advertising you could spend because it's almost zero. And so their advertising cost percentage might be much less. And I'll give you that fun tip that if you're trying to attract new clients, the number one thing you could do right now is to increase your Google reviews. And that is free advertising right there. And so because what happens is that will automatically help your SEO organically. So you're not paying for SEO. And it also gives you trust in the marketplace because when people are Googling for an attorney and you're coming up and they're reading reviews about things that people have said about you, that's going to give you that buy-in already. And so that's the best use of marketing time right now that we're seeing. Okay, so let's hop into budgeting. And what I mean from starting from the bottom, we're going to figure out first, how much do we want to make? And that number is completely subjective, and it can be $1 million and it can be $50,000. That is very dependent on what you want out of your life and your personal life and firm and all of those things. And so once we know that number, then we're going to figure out our gross income. What are we projecting in revenues? If we know we're spending extra on marketing, what do we think that gross revenue is going to be? Especially if you have historical data, you can kind of start to see trends and see, oh, well, we've increased, every year by 8.3%, something along those lines. If you have that data, you know where your gross income is going to be, and then you're going to set goals for that. And so that then is going to tell us what we're going to spend on our expenses and our overhead. This makes it really tight, but ultimately at the end of the year, you end up with the net income that you want to be at. And then, because what happens while you're growing firms is it's very easy to say, oh, we need this new software. We need this new hardware. We need this new shiny thing. There's always something that if we don't have that budget in place, then we're never going to hit our net income goal. But as I say that, I do think a budget needs to be flexible because let's say our gross income goes up significantly. Now we need to hire new staff. Well, that's going to be out of budget. So what we would do is mid-year, we would just adjust that budget based on what we think is going to happen the rest of the year. So there is some flexibility inside of a budget that you do need to have and take into consideration as you're planning your firm. But ultimately, if you're doing this method, it's going to put you more in control of what your net income is and what's left over, what you get to take home. Okay, number 7 is we're going to set KPIs that are going to help reach our goals. So I don't know how familiar everyone is with KPIs. That stands for Key Performance Indicator. And it is a activity-based number that's going to help us see if we are going to get to our goal. And these are also really good because sometimes we don't want to share our full financials with our team. You may not want them to know all of the things about the firm, but what you could do is set up KPIs, and that could be something that your team sees. You would put this into a scorecard, and we'll show you that in a minute. But that way your team is getting a glance of where we're at in our action steps and not necessarily all of the financial data. And these KPIs are set to give us a quick glance of progress. You would not want to have 30 KPIs because that would never be quick. We want to keep it to a minimum to where we're looking at 5 to 7. As you grow, that KPI number might grow because you might have different departments. If you grow, you may have a separate marketing department. They would have their own KPIs. And maybe you have different types of practice of law, maybe those different types would have different KPIs, because they're just very different in how you operate. And then a KPI is always going to be leading instead of lagging. So what that means is a KPI is giving us a target of what action we've taken, whereas a lagging is always going to give us the history. So like a profit and loss statement is going to be a lagging KPI because it's in the past and it's already done. We can't go back and change it. Whereas a leading KPI is we're going to be able to see when we need to improve it. A great example of this that I always give is on weight loss. So if you wanted to lose weight, what you do want to measure your current weight, so you would know, but then you want to start measuring number of calories, number of minutes you exercise, number of steps in the day. Those would be KPIs, because we know if we hit a certain target, then we would hit our goal weight. So that's a good example to look at leading versus lagging. Weight is lagging because you can't change it. It is, in that moment, it is what it is. So what type of KPIs would you have in your firm? And again, this is very dependent on your goals and what you set up, which is why I said in the beginning, let's go ahead and set 1 year or 3 year goals, because that's going to depend on what's on your scorecard. So for instance, and these are real KPIs that some of these are ones that we track for current clients now. Let's say, you're in growth mode and you have a revenue target you want to make. And in order to make that revenue target, we need to have 10 consults every month, because we know what this is telling me, we know of those 10 consults, we're going to open 5 new matters. That means we have a 50% conversion. 50% consults are only going to be a consultation. We won't move forward. 50% we would. And so again, this is going to help us predict what our revenue is. And you can also start to set team goals around this, and make someone else accountable for them. Especially if you have an attorney in the firm and their job is consultations, then these are really their goals. Their goal is to have the consultation and then get the new client, open a new matter. And then we would track what's our dollar value of new matters. That I know can be tricky and it can be all over the place. And it's probably going to be dependent on the type of law you're practicing. But if we can attach a number to that, we can start to predict out, okay, well, we're going to have 5 new matters every month at $2,500. And so that's the revenue we know we're going to have, because those are our targets we're hitting. And then a good metric is number of months of cash on hand. Let's say you want to have 6 months on hand, you can start to track, okay, well, how much is on hand at the end of every single month? And so this is a good metric that, like, we're not telling our staff we have $50,000 in the bank. They have no idea how much is in the bank. But what we're telling them is we want to have 6 months on hand, and here's how many months we have right now. So you can see where we're not having to share all of our financial data with our entire team, and it's just the information they need to know. Then the last one, social media followers. Obviously, if that's your goal is to grow and to be more visible online, we would want to set a goal, and then we're going to measure that goal every single month. So you can see where these are just going to offer us very quick feedback. And we're not going to be able to get into the details. We're just going to see high level, and that is what we need in a scorecard. All right, I know this is your favorite. Everyone's been waiting for taxes. Let's talk about taxes. I will first say that paying taxes is a sign of a successful business. It is very hard, especially as an attorney. You're a service-based business. It is very hard for you to be profitable and pay 0 taxes. Now, there's a lot of strategies that could make that happen, but those strategies are going to be very dependent on what your goals are. Because if you come to me and say, hey, my goals are to purchase a building in 3 years, we would never want to run your profit to 0, because you would never be able to buy that building. So your taxes, I want to say that just be very proactive with them. One thing that I hear a lot of times is my CPA never talks to me about this, or I talk to them once a year. And I really want to push that back on you and making sure you're being proactive and you're reaching out and having those conversations. And then if those conversations aren't happening, maybe look elsewhere. But by nature, a CPA is very reactive. And so I would say go and ask for what you want from the professional you're using now and see if you can get that there. And ask them and say, you know, hey, I'd love to know where I'm at right now. Can you give me a tax projection? Or, hey, can we talk at the end of the year and do some tax planning? The best time to do tax planning is right now, or, you know, anytime throughout the year, but we can't do tax planning right now for 2024 because that's done. So make sure you're being proactive with the professionals that you're using. And if you're not getting that, look elsewhere. And then I guess I kind of jumped out of order, but that middle bullet point we talked about before, make sure you're setting money aside for taxes, because you do not want to get caught off guard come tax time and not have the money to pay that, or be blindsided and now it's just messed up your plans for the year and you don't have the money to do other things. So we want to have a system in place, and we're setting money aside every single month for taxes. But number one point on there is definitely, if you want to have a successful firm, you're going to pay taxes. We just want to keep that to a minimum. All right, number 9, making the time for finances. This could be one of the most important on the list, because if you know all of the things and you have all the data and everything is accurate, but you're not making time for it and you're not making this a priority, then you will not see your firm finances start to get better. And what we want to do is, like I said before, we want to create a habit, and we want to block time on our calendar. So that is the number one thing that I don't see people doing. One thing that I do, even in my own firm, is I have Firm Friday. That's the theme of the day. On that day, I'm going to work on finances. I'm going to work on any type of things that are going to make my firm better. That's the time we're working on the business and not in the business. And so if you don't block the time on your calendar, you'll get busy. I mean, you know, you're running firms that I tell people all the time, I'm like, if it's not on my calendar, it's probably not happening. So put it on the calendar. So let's go through these again. We're going to make sure we understand our balance sheet. That is so key. That way we know it is accurate and we're looking at good numbers. We're going to make sure our accounts are reconciled every single month, whether you're doing it, it's outsourced, someone is reconciling them as they should. We're going to start to increase our cash position, and we're going to do that by having different bank accounts that we can set money aside for growth and for taxes. And then making sure that we understand what our trust requirements are and that we're hitting those and there's no issues there. We're going to know our labor costs, because that's going to help us know when we can hire more or when our staff should be able to produce more and those types of things. We're going to make a budget and review it regularly. Right now is a great time to make a budget because we're at the beginning of the year. So you can go ahead and make a 2025 budget, get that into your accounting system so that you can look at it and compare it every single month. Then we're going to create our KPIs and put them on a scorecard. And a scorecard can be something as simple as a Google Sheet, Excel spreadsheet, whatever it is. You do not have to go buy fancy software to track KPIs and scorecard. We're going to put those on something very easy so we have them and can refer back to them. We're not going to ignore taxes. Do not put it off. It will not go away and it will not get better. So do not ignore them. And then we're going to put time on our calendar for all of these things so that we make sure we're doing them. And then we're going to be able to understand this better. And that's going to give you the power to make better decisions, to make faster decisions, and to know that you're headed in the right direction. And here is my email address. We do have a landing page that tells you a little bit more about how we help law firms If you have any questions, I will be happy to answer them. You can shoot me an email. I do not mind. You know, if you have a specific question, I will give you very general advice because I cannot give tax advice to non-clients, but I'll be happy to point you in the right direction and give you some answers.
All right, thank you, Joy, very much for your presentation today. There are a few questions. Let me first answer the question, can we get the presentation to be able to download it? The answer to that is yes. You can go to the closed Facebook group for the Florida Bar Solo and Small Firm section. That is a member benefit that you have by being a member of the section. All of our CLEs that we do for Wednesday Wisdom are archived there to where if you're running short of credits, you can go back and look up to 18 months for prior CLEs to get credit for those. And then questions directly to you, Joy, and we'll have to do this quickly. I'm going to have to close this in about 2 minutes. First question was, if I pay my payroll taxes every single month out of my operating account, do I really need a tax bank account? If I owe at the end of the year, it's minimal due to the monthly paying taxes.
Yeah, I think if you don't have a tax liability, then you don't really need a tax account because it really is just for income taxes.
All right. And then additionally, how many months in advance should you start tax planning? My CPA always wants to meet in November, and I feel like that gives us no time to actually put a plan in action before December 31st of that year.
Oh, that's a good question. I think it depends on how long you work with that CPA because he may have knowledge and just know that he has enough time, you know, that late in the year. Or if this is a newer CPA you're working with, I would say a little earlier in the year. And so I would say I would just ask for it. Ask for what you want is one of the best advice I can give anyone. So just tell them, hey, can we do that mid-year and see what they say.
All right, thank you. So based upon the time, we're only supposed to go to 12:50. I'm going to go ahead and close things out. I do thank you, Joy, for sharing your knowledge in this presentation here today for this important program. And I also thank each of you for participating in this Wednesday Wisdom that is provided to you at no cost by the Solo and Small Firm section. We hope that you found this program useful and welcome any suggestions for future programming. Now, as far as getting credit for today, the course number is 8624. Again, it is 8624. It was also on the initial slide. You will need to log into the Florida Bar member portal in order to log your own credit. That is not done for you. And then, Joy, are you okay with sharing your PowerPoint with everybody?
Yeah, I'll just send that out in the email thread and you guys can distribute it.
Okay, thank you very much. If you'll send it to Gabby, and then for those that attended today, we'll just go ahead and get that sent out to everyone as well. So thank you again for attending, and as always, thank you for your help with our section as well, Joy.
Thank you for having me.
All right, take care, everyone.